Joining us now to talk more about banks and the broader market is Unlimited co-founder and CEO Bob Elliott. I'm getting used to Friday, Bob. I like having you here. It's usually rainy here as well. We got to fix that.
Today.
It is. So Leslie mentioned we're at these lows on the KRE since May. We're also, I think, at a low for the NASDAQ since May. What to make of all that?
Well, I think when you look at the banks, we are starting to see some concerns that are emerging, not so much for the big banks, not so much for the small banks, but sort of those regional stuck in the middle are starting to see some pressure. They still have a little too much duration on their balance sheet. They're still seeing, obviously, some hits as a result of the bond sell-off. These are the sorts of things that are not quite big enough to be a big deal to the Fed to cause them to pause or hesitate in terms of keeping monetary policy tight as it is. But it is enough to obviously scare shareholders in terms of what the forward-looking picture looks like.
Okay, so bigger picture, your position, I think, still is that we're late cycle, a recession is coming. That's different from what Atlanta Fed President Raphael Bostic said on Squawk Box this morning. He said no recession coming. You still expect a recession? Do you have any perspective on how deep and how soon?
Well, I think one of the things that, of course, the Fed's not going to sit there and tell you that a recession is coming relatively quickly, particularly when they're holding tight monetary policy in place. But it's the sort of thing where just as everyone is sort of giving up on this recession because it's come, much later than most people have expected, the storm clouds are gathering, right? You've got the backup in bond yields. That move is directly hitting incremental borrowing and the vast majority of borrowers. You've got, frankly, the fact that we've had a longer and longer term of elevated bond yields, which means that those who have hesitated to borrow are now starting to run down their cash piles and now starting to face a need for increased borrowing ahead. And the fact that you're starting to see weakening in various more cyclical sectors of the economy. Housing had popped and now is rolling over. Employment, here and there is getting weaker and weaker. And so the odds that we get out of this without having a meaningful slowdown in economic activity are pretty unlikely.
All right, we're going to stick with this theme because, Bob, stay with us. We have a news alert on the Fed, which just released its latest financial stability report. Steve Leisman has the details. Steve.
Sounds like Mr. Elliott could possibly have read that report or written it. The Fed in its twice annual financial stability report not finding serious areas of concerns in the banking system. They call it sound and resilient. But it does flash a series of yellow warning signs here in various markets and industries. Many of those risks caused, in fact, by the Fed's own hike in interest rates. The Fed said some banks saw declines in long maturity assets due to rising rates, and some banks are facing funding strains due to high levels of uninsured deposits. But they're saying the reliance on wholesale funding is lower right now, and outflows have slowed. Banks overall, they say, have high capital ratios. But prime and tax-exempt money market funds, along with stable coins, they say, remain vulnerable to runs. Property prices are elevated relative to fundamentals, according to the report, and mortgage delinquency rates do remain low, however. On the equity market, valuations remain notable. I think it's a little higher than they would otherwise seen historically. Equity price gains, they say, exceed that of expected earnings. One-year loan default rates stand well above the historical median, according to the report, and the Treasury market liquidity may be less resilient than usual. On commercial real estate, they do flag that. They say valuations remain elevated, and there are concerns among those who they surveyed for part of this report here. Leverage of non-financial firms remains high by historical standards, and there are signs of deterioration in the corporate bond market credit. Just a couple near-term risks they note: the China slowdown, the sustainability of the fiscal side of the fiscal debt, worsening geopolitical tensions, along with persistent inflation and a significant economic slowdown. Nothing here, guys, where it sounds like the Fed is going to do anything imminently about it, but these are some of the warning signs that they flagged, many of these issues resulting from the huge surge in interest rates by the Fed itself. John?
I'll take it, Steve. Thank you, Steve Leisman.
Okay.
Yellow flashing lights seems to be the right metaphor here. I mean, there's so much we can pull out from what Steve just reported. Your reaction?
Well, I think the main question for the Fed is what's going to cause them to shift monetary policy from this stance of higher for longer to something that's going to be a little more accommodating. And what we see in that report and what we hear from what they're saying is, there's nothing that is a sufficient imminent risk that's going to create a desire to shift towards easier policy. And so it's, higher for longer as far as the eye can see. And the issue is for most businesses, and a lot of what was just discussed in that report is every day that higher for longer policy stays in place is a continued weight on the economy. And over time, the slow but sure weight of that economy is going to tilt us into a recessionary dynamic. And that's coming at a time when earnings expectations are so elevated, right? 25% earnings expectations growth over the course of the next 2 years at a time when higher for longer is firmly in place. Those two things are out of sync with each other, and the stock market hasn't really resolved that situation.